Institutions are quietly accumulating crypto. You won't see it on charts. When people talk about crypto, they usually focus on price. What's pumping? What's crashing? What's trending on exchanges? What if the demand you're waiting to see is happening somewhere else? But most institutional crypto buying doesn't happen where you can see it. It happens quietly, off the charts, away from public order books. And that's not a secret. It's by design. What if the smart money doesn't buy like you do? Because it can't? Because most retail investors assume one thing. If institutions are buying, you'll see it in the order book. You'll see the volume. You'll see the breakout. The average crypto investor looks at the same places: exchange volume, candlestick charts, order books. When prices fall, the assumption is simple. Smart money is selling. Institutions are exiting. Demand is gone. But that assumption relies on one mistake. It assumes that large players buy and sell the same way individuals do. They don't. Institutions don't buy crypto like retail investors. They can't. Large market orders move price instantly. They alert traders. They create volatility. Let's ask something uncomfortable. If you were managing $50 million, $200 million, or $1 billion, would you smash the market buy button on a public exchange? Would you announce your intent to every bot, every trader, every whale watching liquidity? Because that's what a big market order does. It moves price. It creates slippage. It signals urgency. It tells the world, someone big is here. So institutions don't buy crypto like retail, not because they're secret villains, because visibility is risk. Now here's the next question. If the biggest buyers avoid public order books, where does that buying go? And why don't you see it? They signal intent. For an institution deploying millions or billions, visibility is risk. So instead of exchanges, institutions use over-the-counter markets. OTC transactions happen directly between parties through brokers at negotiated prices without hitting public order books. The result? Demand increases without price movement. Why does this look like weakness? From the outside, this creates an illusion. Prices drift sideways. Volume looks muted. Sentiment turns negative. Retail assumes nothing is happening. But OTC, over-the-counter, accumulation doesn't show up as green candles, sudden spikes, exchange inflows. It shows up later, only after supply has been absorbed quietly. By the time charts reflect demand, the accumulation phase is already over. Why this phase shakes people out? This environment is psychologically exhausting. No excitement, no confirmation, constant doubt. Price volatility triggers fear. Silence triggers boredom. Time triggers frustration. Retail exits not because the thesis failed, but because patience did. That's how quiet accumulation works. It doesn't force people out. It lets them leave. This isn't just in cryptocurrency. This pattern isn't new. It appears in equity accumulation, commodity stockpiling, distressed asset buying. Public markets reward confidence. Private accumulation rewards discretion. Crypto just makes the contrast more visible because the tools are public and incomplete. What looks like neglect is often preparation. In an era of monetary expansion, structural debt, asset scarcity, declining trust in institutions, large players don't rush, they position. Crypto accumulation isn't about hype cycles, it's about optionality, about being exposed without being obvious, about preparation, not prediction. Why the charts can look dead while buying is happening. What does this really mean? If you're watching charts for signals, you're already late. Institutional positioning happens quietly, slowly, and privately. By the time it becomes visible, the decision was made long before, and that's the part most people never see. Trading over the counter, it's not magic. It's not illegal. It's not new. It means large trades get negotiated directly between parties, usually through an OTC desk or broker, away from the public exchange order book. So instead of placing a visible giant order on Binance or Coinbase Retail, they request a quote privately. Ask yourself, if you could buy size without causing a spike, why wouldn't you? Some institutional platforms and desks explicitly talk about this purpose, executing large volume trades with minimal slippage, and doing it in ways that don't broadcast the order to everyone watching. Now look at the illusion this creates. Price drifts sideways. Volume looks muted. Sentiment gets bored or bearish. Retail says, nothing's happening. Institutions aren't buying. Demand is gone. But that conclusion assumes all demand must hit the exchange. What if the supply is being absorbed quietly, and price doesn't need to explode yet? Because if OTC desks are matching big buyers with big sellers at negotiated prices, the trade can happen without the same footprint you expect on a chart, and by the time the chart finally reflects it, the accumulation phase is often already finished. How is this possible? The mechanics retail never learns. Let's break down the mechanics in a way retail almost never sees. Step 1, a fund wants size. They don't want slippage. Step 2, they go to an institutional venue or OTC desk and request a quote. Step 3, the desk either finds the other side or internalizes the trade using liquidity relationships. Step 4, settlement can happen via custody, prime platforms, or direct transfers, often with compliance checks. Some institutional platforms also use execution strategies like iceberg and TWAP-style orders to reduce market impact when they do touch exchanges. Now the big question: if trades can be negotiated, netted, or executed in ways that reduce footprint, why would you assume the public candle tells the whole story? Why don't people talk about this? It's not secret. It's not broadcasted. Here's where people get emotional. They say, why is this kept secret? Why isn't this explained? Is the market rigged? Let's be precise. A lot of this isn't secret like a conspiracy. It's just private because institutions demand discretion. OTC negotiations are bilateral. There's no universal OTC tape like retail expects. And many trades don't post to a public order book by design. So the average investor doesn't see it, not because it's forbidden knowledge, but because the tools retail uses are incomplete. And here's an even sharper question. Who benefits from retail thinking the chart is the whole world? Because when retail only understands one arena, public exchanges, retail gets psychologically controlled by that arena. How is this legal? The compliance reality nobody wants to talk about. Now let's hit the legality question head on. How is this legal? OTC trading itself is a standard concept in markets, in crypto, and what matters is who is providing the service and what obligations apply. If a business is accepting and transmitting value, US rules can treat them like money transmitters, which brings registration and AML program requirements. FinCEN has guidance explaining that entities dealing in convertible virtual currency can be subject to money services business obligations, including AML, record keeping, and reporting. So the quiet part isn't no rules. It's usually privacy plus execution quality plus compliance plus reduced market impact. Question: if big desks are doing KYC compliance and risk controls, why would they want the world to watch the moment they deploy size? How many people are doing it? The honest answer: OTC is hard to measure. Now the question that trader, buyers, investors should be asking is, how many institutions are doing this? How many people even know? Here's the uncomfortable truth. OTC volumes are notoriously hard to measure publicly because the deals are private and market data is fragmented. But we can see indirect signals of institutional participation growing. For example, Reuters has noted that while retail still dominates in many ways, there's been meaningful institutional involvement through vehicles like spot Bitcoin ETFs, while also highlighting how much of ETF assets may be held by different categories of investors. We also see legacy finance expanding interest in services around crypto, even big banks exploring additional crypto trading offerings. So if you're asking, how many? The real answer is, enough that the infrastructure exists, keeps expanding, and keeps attracting major players. Here's the part that helps the viewer do something. If you can't see OTC directly, what can you track? You watch proxies, signals that supply is being absorbed or positioned. Proxy number 1, spot Bitcoin ETF flows, capital entering regulated wrappers. Farside publishes a widely used daily ETF flow table and charts. Question: if large pools of capital prefer regulated wrappers, should you ignore flows just because your exchange chart looks boring? Proxy number 2. Exchange balances, exchange reserves. When coins leave exchanges, it can reduce liquid supply available for immediate selling. Not a perfect signal, but informative. Glassnode's exchange balance metrics track coins held on exchange addresses. Question: if coins are moving off exchanges, is that always bearish, or can it reflect accumulation and longer holding? Proxy number 3. Illiquid supply, longer-term holding behavior. Glassnode provides illiquid supply metrics often used to infer long-term accumulation behavior. Question: what happens to price when more supply becomes illiquid and demand returns? Proxy number 4. Futures market activity, open interest. CME provides volume and open interest stats for Bitcoin futures, often watched as an institutional venue signal. Question: if open interest is rising while spot price chops, what positioning might be building? Proxy number 5. Stablecoin supply, dry powder, settlement rails. Stablecoins are the plumbing of crypto markets. DeFi Llama tracks stablecoin market cap over time, and Reuters has reported stablecoin market cap hitting records alongside regulatory developments. How this messes with retail psychology and trades. Now let's connect this to what happens to you. This environment is designed, intentionally or not, to break retail. When price drops, fear says, I'm wrong. When price goes sideways, boredom says, this is dead. When nothing looks obvious, frustration says, I'm wasting time. And here's the brutal part. Quiet accumulation doesn't force you out, it lets you leave. Question: how many people sell because the thesis failed, versus selling because they needed emotional relief? If you're watching charts for signals, you may be late. So what does this really mean? If you're only watching public charts for institutional signals, you might already be late because the positioning happens quietly, slowly, and privately. You don't need to believe in hype cycles. You need to understand market structure, and the real question isn't, why didn't the chart warn me? It's, what else was I supposed to be looking at? Who taught me that the candle was the whole story? And what happens to my strategy if I start tracking what the big money actually uses? Big institutional money is accumulating. You just won't see it until it's too late.